In what's probably the most ironic outcome possible, Tether, the original collateralized stablecoin that's long been a cause for concern for crypto market observers, is the big winner so far in the 2023 monetary policy-induced banking crisis. Over the last few years, we've seen that top stablecoin's market share shrink as U.S.-regulated USDC, a seemingly more reliable U.S.-based and regulated dollar-pegged stablecoin, has been on the rise. But all that's changed now, after billions of dollars worth of USDC's collateral was caught up in the collapse of Silicon Valley Bank. With all those depositors bailed out, including USDC, there's no longer really any concerns about solvency at the second largest stablecoin, and yet the damage seems to have been done. USDC saw some $10 billion worth of outflows as nervous traders swapped their tokens for cash, or you guessed it, Tether tokens. Based on current numbers, Tether dollars now account for some 60% of the entire stablecoin market. Well, we've been talking about stablecoins over the last few years, and this isn't a headline that I think that we would have expected to see if we were talking, at the end of last year. What's your read on what's going on?
Yeah, a lot of my thoughts on this are actually driven by Kiteco Research. It's research team that I brought up on the show a few times. Definitely go check out their newsletter. And they talk about the liquidity in the marketplaces for stablecoins. They talk about stablecoin dynamics, which have certainly shifted over the last 6 months a lot. Starting off with FTX collapsing in November, we just saw like the liquidity of the general market trend downwards. And then over the last few weeks, what we saw with Signature Bank and also the closure of a few other banks in the crypto sector, leading to a liquidity problem for USDC. There was that weekend, I think 2 weeks ago now, maybe 3 weeks ago now, where there was some questions about like what would USDC do when banks opened on Monday? Were they going to be solvent or not? Were they going to be able to offboard people who wanted to offboard from USDC? Were they going to continue tokenizing dollar reserves? And turned out that yes, that they had enough banking partnerships, they're able to steer clear and keep this thing running. That doesn't mean that you don't have any casualties from the battle though, right? There's going to be some scars. And so far it seems that people are offboarding from USDC because they probably just don't want the exposure. And we're seeing a few different firms doing that, including some firms like Voyager who are going through Chapter 11. We also had that headline from the FTX Chapter 11 case where they were moving around stable coins. So we didn't quite know if they were trading the stablecoin arbitrage trade there or if they were just like offboarding from USDC and minimizing their risk. That being said, the winners here are pretty clear. Tether is a big winner, which of course, like you said, Adam, has long been in the scope for a lot of people. A lot of crypto critics have taken shots at Tether and somehow it survives it. But also TUSD, which is another interesting stablecoin. It's now a top 5 stablecoin and it's doubled its amount of tokens on Binance because Binance has been saying, hey, maybe use this stablecoin instead of BUSD, which is having its own problems. So really right now, we're just seeing a rotation in stablecoin markets between different products based on how traders and other market participants feel about the security of the investment. Jen, throw it over to you.
Yeah, you said kind of what I was going to say. So I think when I look at the stablecoin market, I feel like it's this game of whack-a-mole right now, right? It's like one stablecoin is on top until something happens that makes it lose its peg. There's something happens with regulation or something's happened with the centralized point of how the stablecoin operates. And so I just feel like we're going to see during this uncertain time, like different stable coins rise and different stable coins maybe fall and take that first, second, or third space. I wish Zach was on the show because he has brought up the blog post by Arthur Hayes a few times now, and I haven't read it, but from what Zach has told us, it references algorithmic stablecoins and the need for algorithmic stablecoins to kind of combat the centralized failure that we're seeing with all of these stablecoin projects. And so I think that need is still there, an interesting one. I don't think regulators are going to like it, but will, like you said, I think that these numbers show that after a few weekends ago, a lot of people who held the majority of their treasuries in USDC were looking to diversify and they went to Tether. Adam?
Yeah, it's an interesting reality that we find ourselves in on this, because one of the interesting parts about this is that we don't actually know that Tether didn't have a similar problem. We just know that they didn't have to disclose it if they did. It's unlikely that they had this particular problem because they basically haven't been in a position to get a U.S. bank account for a long time. And that is really kind of what the dislocation here was, is it was, again, about sort of the failure of a series of U.S. banks, and then people who had deposits in those U.S. banks then became imperiled. So it's not that, so it's just interesting, right? It's like, again, it's like the downside of the higher regulation burden competition seems to mostly be a downside when things go wrong. Both because you have to disclose things as publicly traded companies that you do not if you're just, Tether, wherever the heck they're based. And similarly, again, like we just don't know a bunch of these things. So it's not even necessarily that Tether is better. It's just that maybe they didn't have the optical failure that sort of occurred here, and we'll take the best option as we can see it, lacking any additional information. I don't know. It's a weird dynamic, but the one thing I'm pretty certain about is that algorithmic stablecoins, to the extent that they've been deployed so far, probably don't present a solution for this. People are always trying to come up with ways to do stablecoins that don't have risk implicit in it, and that just is impossible. You get to kind of squeeze the balloon and decide where you want the risk to be. But so far Tether has stood up better than really anything else. You can make an argument that MakerDAO, is another very kind of solid project as far as this goes. But the list is pretty slim, got to tell you.
Yeah, and even to your point, MakerDAO, they have a lot of DAI, or a lot of USDC backing DAI in their treasury. It's nearly like 40% at this point. So even these stable coins are built on top of each other.